Right. Good afternoon. We can start today's discussion. As I repeatedly remind you all, and if you all have any clarification questions with respect to the relevant areas that we are covering, as well as the areas that we have discussed, you can highlight the question so we can follow up in terms of the chat head that's been active in the system itself. So what I just wanted to highlight is the discussion that we were continuing last week. I have updated the one more slide, the last slide, to the discussion itself before we move to the new topic that's been shared with you today. And I believe IBSL has already shared the relevant handouts with you. Excuse me. So you can follow the discussion and you can move on the basis of what we are continuing in our class discussions. Two slides we have used for the last discussion. I wanted to take back and highlight few important elements that we have highlighted in the discussion for your understanding. That itself shows how important the topics that we have covered in recent classes in terms of the yield curve dynamics, term structure, and the risk structure of interest rates, because this has become one of the very key area of kind of signaling where the economies are heading in recent times. And you remember that I was highlighting to some extent when we were discussing about term structure of interest rates and the yield curves. Yield curves serve as an indicator of robustness of economic expectations. And in the case of US, I was highlighting you all, in the event of a downward sloping yield curve, it's kind of considered as an indication that the economy is heading towards a recession. So that's one way of looking at how important some of these elements are. But interestingly, I would take that slide as a part of our discussion today and highlight you before starting where we stopped last week in terms of economic analysis of financial structure. And the last slide of this lecture series is available and uploaded by IBSL for you all to access. And if you all access this website where I have highlighted the link, the worldgovernmentbonds.com, where Sri Lanka been highlighted, and the web page, if you just approach it, you will hit the page what you see in this slide itself, where Sri Lankan government bonds yield curves being discussed. And you probably see the three yield curves referred in the right hand side of the slide itself. There you can see the latest one, that's in blue. And what you see is about a month ago, that's in green, and then about 6 months ago, that's in yellow. So what you are basically seeing is how the yield curves have adjusted downward in recent times with the adjustment in policy interest rates and the structure along the different time to maturity assets that we discussed. So what you are basically seeing is the elements of conducive monetary policy circumstances in Sri Lanka, coupled with the more systematic and information symmetry-based issuance structures adopted by the government bond issuers. You probably see much more aligned, much more adjusted yield curve is now visible with a small, if not mild, upward sloping shape. That's the blue one. It's very clear. And you can see government's cost of financing also adjusted significantly over this 6 months period from 10% levels of medium term to long term maturities of close to 15 years, now settling around 7% like. So it is almost like 300 to 350 basis points adjustment, right? So you can see also Sri Lanka's the yield comparisons, like 1 year to 2 year gap is about 19.5 basis points. 2 year to 5 year gap is about 105, whereas 2 year to 10 year gap is about 149. So what it means is incrementally yield curve is flattening. And you probably listened to us when we were discussing the expectation hypothesis explanation of how the shape of the yield curve explains the different maturities yield structure, and level adjustment across all the maturities is very clearly visible. And you can link this in terms of the equation itself, where L and T, we discussed about so-called L and T, that's time premium I was referring to you. So the time premium shaping the yield curve to be still upward sloping, but it's milled. Okay, so this itself explains you many aspects that we have discussed in recent classes, and you may be able to apply some of these elements into the discussion, and also in terms of application of knowledge that you have learned in terms of analyzing market development. So this is a very important element. That's why I brought in this slide, although this slide is not necessarily part of the financial structure discussion, but this is very clearly relevant to term structure and risk structure that we have discussed about two to 3 weeks ago. So this again gives you a much more clarity. And you can also, if you go to this website, you can also go into other concepts like inverted yield curves that we have discussed. And then also you can discuss and find out how the other markets behave in terms of US, in terms of Germany, Canada. These are all advanced market. Okay, and also some elements of information in terms of Sri Lanka's government securities market and its behavior in recent times. So Sri Lanka is very much orderly in terms of what you are seeing in these yield curves, and can be explained by certain theories that we discussed, particularly in terms of liquidity premium theory. It is nothing but extension of expectation hypothesis with a liquidity premium or time premium for that matter. So I hope that you can apply the knowledge that you gain through all these discussion in our classes. So let's move on, and we'll try to discuss the topics that we were discussing. I will basically start with the moral hazard that we were basically touched upon last time, but I will continue with that section and the following element, because I discussed about the principal agent problem. You know, the principal is the owners or the shareholders or the investors through a firm. The agents are the managers or the executives. So they have conflicting interest at times. So this creates so-called agency problem, that is principal agent problem. To solve this type of problems, you have to have verification arrangements. These are costly. This is through monitoring arrangements that you can have. Even kind of, you know, CCTV camera arrangement is a monitoring. But on top of that, independent verification, third-party verification. Even if you apply to an employment, you probably see a non-related referees. So why they call non-related referees? So it's similar to that. I mean, you can apply such arrangements to figure it out. The agents or the executives are actually following arrangements in line with the organization's objectives and goals, or they were maximizing their own benefits in the form of higher risk taking, thereby reducing the lifetime of the organization as well as possible resources like machines and tools. So this is like, you are looking at all these things. Then of course the free rider problem, you probably see the free riders, they do not necessarily put the relevant effort or required efforts, they depend on others. So instead of a single exam where one could copy and pass the exam at times, so there may be a continuous evaluation arrangements. So you might not necessarily be able to have the kind of possible one-off cheating and then get rid of get caught to kind of a monitoring arrangement. So these were kind of tools that has been introduced in recent times across institutions, and even probably in education related institutions. You probably see now unit-based education, regular evaluation systems instead of periodic one-time exams. So these are the kind of changes that you see. Then you can compare this with the fact one that we have explained. So we were looking at 8 facts. I'm not reading those facts again. You can compare this and this solves the fact one to some extent. So then the government regulation. Okay, so government is kind of introducing regulations to increase the symmetry of information or reduce the asymmetry of information. So thereby information available to the stakeholders is very much available. So what you simply see is, for instance, if you look at the stock exchanges, there's a regulation that if you are a listed company, you had to provide unaudited accounts within a certain duration, but audited accounts necessarily after a certain duration, like 3 months of a completion of a quarter. Okay, so you basically required to comply with these terms if you are a listed organization. So that information is available. Okay, then similarly, if there's a changes to the, if there's a change for the decision-making structure like board of governors, for that matter, in organizations, or the director boards, or the chairmans, or somebody is intent to resign 6 months ahead, that needs to be communicated if he's occupying a very senior position of the organization. Then similarly, who is going to replace him, that needs to be known to the market. For instance, if you look at institutions like Bank of England, Federal Reserve, European Central Bank, ECB, mainly the advanced countries, central banks, they also follow a very similar structure. You have to keep the replacements known to the market in advance, so they know the merits and demerits or the previous track record of these people, and whether they are in line with the current thinking of central banking. You can measure those stuff. Okay, but this is a tool in terms of introducing government, introducing regulation to help availability of information for decision making by stakeholders, through which any advantage one could have in the form of agents maximizing their benefits can be minimized. So thereby they can reduce possible insider trading. Okay, or they can reduce the possibility the price sensitive information being kind of available with only one segment of the market. Price sensitive information means the information which has impact on the pricing of a financial asset. Okay, so these are the elements that you discuss when it comes to certain tools that available for available to solve this agency problem. So then financial intermediation itself is a tool where instead of you yourself, right, try to ascertain, if not collect or pool assets or the finances required for your projects, the market is facilitating you in the form of pooled funds available through savers from one side, and from the other side, the entities which are short of resources can access to these financial intermediaries. So the financial intermediation is facilitating through its specialized skills, knowledge, expertise, and market know-how to bring in required resources for all new projects new proposals, venture capital source arrangements, and all kind of things. So you see this financial intermediation also available in terms of facilitation. And then another element is contracts, especially the debt contracts. So that again define the course of action in the event of a mishap. So if you jump out of the required path of defined arrangement, so there's a course of action in the contract itself. So this also solves principals and agents kind of deviating from their engaged or discussed or contracted path in terms of achieving the desired goals. So these are very, very efficient way of handling. But of course, the contracts, when it comes to debt contracts particularly, some element of expertise is required. So that's why again financial intermediation is favored, because financial intermediation has established know-how and also the expertise and also scale benefits. So they do not necessarily sit there to do only your contract. They are doing these contracts for thousands of others, thereby they are spreading out their cost elements. And also through their engagements, repeated engagements, they know the market trends and also the emerging kind of risk in terms of most of these contracts, though they bring in those elements also into the equation. So you can see, I mean, the relevant tools available to address these problems in the market. Okay, so you can go on and explain these arrangements to solve these principal agent problems. And then moral hazard. Okay, so we look at the financial structure. The moral hazard is, often occurs after the transaction, right? So you are taking excessive risks. When you have insurance, your behavior is different to when you do not have an insurance. Okay, so when you have medical insurance, how sometimes you behave. So when you have motor insurance, how recklessly sometimes you drive. So somebody else is taking the liabilities in the event of an accident or anything. So similarly, the financial institutions also, when they have central banks, they think them as good fathers. They come and bail them out. I mean, it's itself kind of has merits as well as demerits. But what you are simply seeing is a moral hazard influences on financial structure, and also through which one would define which type of finances are useful for organizations and different market environments. Okay, so borrowers have incentives to take on projects that are riskier than the lenders would like. That's the main concept and explanation behind moral hazard arrangements. You probably produce your project proposals in line with a certain risk structure, right? But when you receive the finances, or once you have all the finances being cleared by financial intermediaries, it's not your own capital to great extent. It's a liability that you have created in your portfolio because you have borrowed these funds. So in the event of the borrowing, you do not take required adequate measures to kind of protect the interest of lenders. So this is the moral hazard. If it is your own money, you probably be behaving differently. Okay, so the borrowers have incentives to take on projects that are riskier than the lenders would like if the moral hazard exists in financial markets. Okay, so this invariably prevents the borrowers from paying back the loan. They even kind of run away, leaving the whatever collateral or the assets, and collaterals also sometimes changes with market conditions, right? Or you probably have painted the collaterals with a higher valuation probabilities, and through which you probably kind of drive lenders to suffer from failed projects. So this is also another element in today's context, even in Sri Lanka, where banks who have mainly the banks but mainly what you can call it financial intermediaries, they have excess liquidity. And also, recently the statutory reserve ratio also adjusted by 2% by the central bank, and thereby we released about 115 billion rupees to the market. And altogether, over the last 6 to 8 months or so, we have reduced the statutory reserve requirement by 3 percentage points, amounting to about 180 billion rupees. So these resources have gone back to the financial intermediaries, mainly the licensed commercial banks. So these commercial banks can lend that amount of money to the market, but still most of them are keeping a reasonable share of this reserves in their portfolios rather than lending, because they are worried that if you lend under current circumstances, under special schemes that introduced, without having adequate and kind of valuable collateral, they would not be able to get this being serviced by the borrowers. So the borrowers also, from another perspective, probably try to give the most in a sense less valuable collateral to the banks and try to get the finances. That is the lemon problem that we discussed. So the problems that we are seeing in terms of moral hazard is it's still prevalent, and you can interpret the recent behavior of both the borrowers as well as lenders, even in the case of Sri Lanka, to some extent in the form of possibility that the borrowers have incentives to take on projects that are riskier than the lenders would like, and also without having proper and valuable collaterals being lined up. So these are the kind of explanations that you can give in terms of the knowledge that you are gaining from this particular program and applying them to the current circumstances in the market. So this is another benefit of kind of, learning some of these elements in discussions. Okay, so what are the tools then you have to solve these moral hazards? Okay, so naturally, I mean, net worth and collateral. Net worth. I mean, higher net worth is always links with higher probabilities of having access to financial intermediaries and having lending arrangements at the most preferred terms and conditions. Sometimes we call it prime lending rates. So these lending rates are offered to prime customers of financial intermediaries. So they are having high net worths. And anybody who has high net worth and collateral would be able to provide them, and through which you can solve some of the moral hazard probabilities. So if you have valuable collateral, yes, and also the collateral in current sense required at times with adjustments on the basis of market valuation practices. So this is mainly the financial assets. If you keep financial assets as collateral, let's say bonds, so the bond prices changes with market interest rates. So when the interest rates reduces, the collateral prices increases. Okay, right? So the collateral value increases when the interest rates decreases. Similarly, when the interest rate increases, collateral value decreases. The inverse relationship between price and the interest rate, right? So you see, higher the interest rates, lower the price, lower the interest rates, higher the price. Higher the price means the collateral values are increasing. And when you keep collateral in the form of financial assets, particularly bonds, and you see when your prices increases as interest rates decrease in the market, you can pull out part of your collateral, right? So you don't need to lock everything that you have locked 3 months ago. So you can pull out part of your collateral, and still you have other usages from that collateral you locked up, right? Similarly, when your prices decreases, you have to bring in. So these are part of so-called derivative kind of transactions that you will discuss in higher level of courses. But what I'm simply saying is, I mean, these collateral possibilities would solve some of the moral hazard probabilities, and also linked up valuation variations in the markets. So the financial intermediaries also in today's context much more happier to use financial assets as collateral instead of properties or other assets that one could require to go through in terms of liquidity considerations. Okay, so this is invariably incentive compatible. So net worth and collateral would bring in a value to your access in terms of financial intermediation, and at the same time lenders also are much more happy in terms of balancing their possible risk in terms of possible moral hazard action by the borrowers. So you see these possibilities, and then you see monitoring and enforcement of restrictive covenants. Okay, so the contracts that we were discussing, especially the debt contracts, have number of elements which restrict lenders or the borrowers from taking unilateral kind of arrangements. So you have to have arrangements in mutual consent, and this areas of elements are very clear in terms of legally binding contracts you enter with lenders most of the time. So you cannot kind of run out or jump out from these contracts on your own. You have to have the consent of the lender. If you are a borrower, you can't run out on your own. Like, so you see these type of elements also help to solve possible moral hazard behavior, so through which that discourage undesirable behavior. That means one-sided behavior. Okay, taking unnecessary risk above what is defined in terms of the contracts. So encourage, from the other side of the coin, encourage the desirable behavior. So you are trying to maximize not only your benefits, but also make sure your financial, if not the lender's interest also being looked. Okay, so collaterals that you kept in terms of the contracts also kind of the adequate if not valuable collateral. So that also part of this enforcement and monitoring of these debt contracts through the covenants defined in the contracts itself. So you see that the collaterals that you have kept, if the valuation changes in terms of market developments, then the enforcement or the monitoring arrangement within the contracts would require you to either change or bringing new collateral until you service out your loan facility with the financial intermediary. Then the information, that is to increase the asymmetry, reduce the asymmetry, right? So when you provide information, the gap between information available to the lenders increases. So your intended behavior is known very much to the so-called the agents who are running the businesses. Principals also know, sometimes more than the principals, the agents are the ones who act on the ground, and they try to kind of follow things in terms of actual market circumstances, and they try to kind of bringing those elements to the equation. So these are very important segments. This helps you to solve some of the problems emanating from moral hazards, okay, through monitoring and enforcements. And then again, financial intermediation. You see, this financial intermediation is always repeating. So that itself shows most of the time when you try to see a financial structure, financial intermediation makes most of the concerns being addressed and facilitate required finances in the markets, right? So that's why the examples that we discussed and kind of seen in terms of empirical numbers, most of the countries, despite their level of advancement in terms of capital market infrastructure and capital market know-how, still they see financial intermediaries are the leading source of finance in their economic activities. US, you saw Germany, you saw Japan, you saw Canada. It's all the financial intermediary driven finances. Still, I mean, you can argue, okay, gradually the increase is there in terms of US, but compared to US financial intermediary strength, still, I mean, the direct finance access is still low, right? But what you are simply saying is, while the direct finances access also expands, you see financial intermediary based access also expands, sometimes faster than direct finance related possibilities. So this itself gives you a kind of solution that financial intermediaries are to great extent solve most of the possible drawbacks in financial structures. And you can go back and read the fact 3 and 4 that would help you to kind of really recognize the role of financial intermediation to solve moral hazard in debt contracts, right? So this table again put down in a summary form asymmetric information problems and tools to solve them. And you have seen now so-called adverse selection. Adverse selection happens before you entering into a transactions. Okay, to solve them, you have a line of activities that we discussed, and we discuss moral hazard in debt contracts very much today, and principal agent problem is mainly coming in kind of equity based contracts, but still it's applicable in a general sense too. So you see these were lined up, and we looked at adverse selection last week, and what you are simply seeing is all tools that we discussed is again produced and repeated. And as I already mentioned, financial intermediation repeats all across all these possibilities. Okay, so what ultimately the asymmetry refers is a level of information available for different parties for transaction differs. So you wanted to increase symmetry by introducing information dissemination arrangements or through regulations. So those facilitate different parties to transaction having equal amount of information, but still kind of interpreting, evaluating, and making use of that available information differs from person to person because of their know-how, expertise. So financial intermediation again tries to kind of help out in that extent. So the facts that we discussed, or the 8 facts that we were trying to understand to see which financial structure is ideal and useful, is again listed out in terms of particular fact itself when it comes to the tools that we are discussing. So I just leave this with you. You can go back and compare the elements with the relevant fact and try to kind of address the kind of problem, asymmetric problem that we looked at in this discussion. And you may refer some of the available literature, particularly the textbook for this matter, and that also facilitates some additional information. But what I have discussed with you, if you follow and repeat a kind of another exercise before you kind of reduce the memory strength in your the memory to great extent, you will follow up most of this stuff. And also you can follow most of the literature in the form of accessing Google, as well as newspapers in countries like Sri Lanka, and also the recent developments in financial markets that you can put in and try to explain also. So these are the elements that you see. It's very much available in terms of solving some of the problems. But then, of course, this asymmetric information also look at from a perspective of non-advanced economies, if not transitional and development economies, okay, where to some extent they call it some financial repression that's been created through the environment in which that you are operating, right? So it's not the financial systems are kind of advanced to the extent where the applicability of contracts can be easily introduced in transitional and developing economies. And also the systems available would not necessarily facilitate speedy solution to some of these problems, right? So you see the asymmetry is then available in these transitional and developing economies due to the weaknesses in the system itself, right? So one element is application of property rights. Okay, so when you see the property rights, collateral that we keep for financial transactions would not be appropriately priced, and also you will not be able to efficiently used. So when it comes to collaterals, in most of the time, in the case of advanced economies, even royalties, right? Even your knowledge itself and your possible future income possibilities. If you are a writer, you have already written some books which are available in the published arrangements, and also the expectation in terms of future lined up production of those authored documents, articles, right, which has some value. So those can be taken into the equation in terms of collaterals. But unfortunately, if you do not have a proper system of property rights, these cannot be used. For instance, the artists, they have the kind of skills that produces income. Okay, singers, dancers, actors, so all have certain element of probabilities they can bring in value, but unfortunately those things cannot be bought in, bring into collaterals and try to price them appropriately, because of your property rights are not defined appropriately. So this is a problem in countries, in transition countries which are not developed. And also you see the legal systems, it's time consuming. Okay, and also we have discussed about enforcing contracts, but it is time consuming and sometimes very difficult to enforce contracts. And to some extent, the banking system has so-called parat execution rights to get hold of some of the collaterals. But unfortunately, in comparison to advanced economies, it's quite challenging in developing and transitional economies in terms of enforcing contracts based on their legal systems. And you probably know how difficult in terms of enforcing a rent contract in Sri Lanka. And also to some extent how time consuming in terms of a property related kind of a legal dispute. So these were kind of not letting these markets to efficiently use the probabilities and available tools to solve some of the problems that emanate from asymmetry. Okay, and similarly, accounting standards. Sri Lanka is, I believe, one of the best countries in terms of application of accounting standards. But then, of course, at times, interpretation of accounting standards, it still has space for improvement. But there are other emerging and transitional economies. They have difficulties in applying standard accounting principles, where the pricing, accounting, and deriving organizations, assets and liabilities and pricing structures, and then of course the cash flows become challenging when you see different standards being applied, right? So this is also a problem in emerging and transitional economies. Okay, so then of course the government intervention, and in fact through government intervention they crowd out resources available for the private sector to efficiently use in its economic activities. Okay, they basically kind of take resources available in the markets, and through which sometimes they propose directed lendings. Okay, so directed lending programs, and this could be executed through state affiliated financial intermediaries. Okay, so through which funds being channeled not to the proper required economically efficient production basis. Okay, so this again kind of makes less intensive incentive in the form of financial intermediaries to also to follow up. That would also create environment where the financial intermediaries would not necessarily lend out, although they have resources. Sometimes this also one possibility. In recent times, the in financial intermediaries and Sri Lanka also not ready to lend to areas of SMEs, where they see SMEs have higher risk in an environment where the economic growth is not necessarily robust. So they see the risk elements on that basis, and also sometimes agricultural related loans in Sri Lanka that also possibly kind of fall into these. And at times the schemes being promoted by politically affiliated elements would create kind of circumstances where the borrowers themselves borrow with moral hazard intentions, right? So that creates kind of unnecessary problems in the eyes of the lenders, financial intermediaries. So the financial intermediaries back off. So who ultimately has to take the lead in such arrangements is state affiliated financial intermediaries. Though they go and contribute sometimes, they themselves were kind of not necessarily having much of a merit-based assessment to kind of facilitate this type of financial intermediation. So these are all kind of possibilities in transitional and developing economies, where asymmetry get too widen in circumstances as we were discussing here. So these contributes to further repression in financial systems, and through which financial efficiency reduces. And we were discussing all throughout how important the efficiency of financial systems that contributes to overall economic prosperity. So that's the base of this entire section that we are discussing. And you see now the elements that we are discussing and its role and how it contributes in terms of expanding the asymmetry in transitional and developing countries in comparison to developed economies. But this all can be easily addressed with proper systems being introduced, and also implementing them with required facilitation. So if that's there, you can see the countries who are now in transition can easily elevate themselves into a higher level of acceptance in financial markets. Okay, so the application ultimately is financial development and economic growth. Okay, so it's financial systems in developing and transitional countries, they have difficulties. Okay, so that keeps them operating below often its potential. That's what we were seeing in our previous slide also, right? So these transitional and developing economies have systems, but they are not necessarily up to the minimum standard of acceptance at times. Even the infrastructure, price discovery mechanisms, legal systems, enforceability of contracts. There are many things, and property rights. We were very much discussing that also. And also the state guided resource directions or allocations. And these are all sometimes helpful, but not necessarily increases the economic efficiency. So ultimately what we are simply seeing here is these constraints efficient operation of financial markets. Okay, so in many developing countries, as we were discussing, the systems of all property rights, all that, the elements that we discussed, that functions poorly, below potential. Okay, making it hard to use them as tools to effectively address the asymmetry driven problems, right? So you see principal agent problem, adverse selection, moral hazard problems, all there. So to address them, the available arrangements cannot be implemented at times, or you might not necessarily have those tools available in your economies. And this is especially in less developed economies, they have the problems of enforcement and also systems of minimum standards that's required for financial markets to efficiently operate. And with that note, I conclude this section of discussion. And you also had the luxury of discussing this last slide today, and that has kind of taken you back to the discussion in our previous lectures. But effectively, this summarizes to great extent some of the developments that you see even in Sri Lankan market, and you can apply them and make use of the knowledge that you have gained over the last 4 weeks or so to kind of interpret things from a perspective of economic application. So you will be able to see them much more rationally now than kind of hearsay or just reading the headlines that might be presented for general readers. So with that note, I conclude this section, and we can move into the next section, that is financial crisis, a very, very important topic. Before that, I would like to see whether you have any questions, any clarification you require, so we can move into that also and see. You can send me a chat message so I can quickly follow up with the discussion before moving to the next lecture, that is financial crisis. Right. Okay, so you must be having the slides with you. The financial crisis, I mean, particularly the 2008 global financial crisis, is the focus of this section, but we touched upon some element of financial disturbances prevail during the early 1900s. And then, of course, the so-called Great Depression. We would look at it because those elements also give us some lessons. But interestingly, we will focus more on 2008 global financial crisis, because some elements of 2008 financial crisis is still apparent in some economies. It's not necessarily completely taken away from financial markets, and also economies are still trying to kind of interpret recent developments, although recent developments are not necessarily financial mishaps, but other elements. But experience of financial crisis, it appears very much useful in current circumstances too. But interestingly, the 2008 financial crisis, where financial markets really felt the shock waves, and the epicenter of the financial crisis in 2008 was the US. Okay, but this financial crisis in US had two distinct phases. Okay, the first phase, you can call it limited. That's the phase from 2007 to 8, August to August cycle. Okay, so mainly the losses in one particular segment in US financial system. Okay, because financial markets in US is very much widespread, and one of the main elements in those market circumstances, the mortgage markets. The mortgage market is very much robust in US, and all financial assets to some extent linked with mortgaged financial products. Right? So here the mortgage market is still prevalent, but not necessarily that much depthful, if not it's not that much strong as you probably see in countries in OECD OECD status. So what you are basically seeing is the first phase in the financial crisis in US was a limited phase, mainly the subprime residential mortgage market driven. Okay, despite the disruptions to financial markets during that period, real GDP in the US is actually still kind of increased. That means the economic growth was still seen. Okay, and the period April to June also seen they had a positive economic growth, and the forecasts were not necessarily predicting a complete kind of a recession, but they expected some mild, that means a very low economic downturn in the form of recession, the negative growth. And you probably listened to our discussions in our previous lectures where the yield curve in US also signaled the direction where the behavior of downward, if not inverted slope, expected some element of recession in US. Okay, but they expected this first phase disturbance to be not significant. That's why the budget office also releases periodic statements in the form of budget and economic outlook. Okay, so even in September, early part of September, they were forecasting rest of 2008 and 2009 for US at that time. The economy is halfway through an extended period of very slow growth. So they are still expecting economy to grow, but at a very slow pace. Okay, whether or not that period of slow growth will ultimately be designated a recession was not clear in their sense, because they have not necessarily seen 2 consecutive quarters of negative economic growth to call it a recession. In US, based on their identification and definition of recessions, they look at it 2 consecutive quarters, 3-month cycles of negative economic growth, that would be considered as a recession. Okay, the increase in the unemployment rate and the pace of economic growth are reasonably comparable with their previous experiences, where they had very small negative growth numbers, mild recession in US history. Okay, but this is interestingly the August to August cycle, and even at the beginning of the month of September, they were thinking they are reasonably safe. But the problems were seen in so-called mortgage market. Okay, mortgage market, but residential mortgage market is the epicenter. That's where the problems were. Okay, but by mid-September, they see the financial difficulties of US enterprises and financial intermediaries is entering into a more troublesome phase. And it was seen that in a rapid succession, one after the other, the investment banks were having difficulties. One of the biggest names in investment bank, in Lehman Brothers, they called and submitted for bankruptcy by mid-September. One of the biggest insurance firm, AIG, collapsed on 16th of September. Okay, they were run on the financial intermediaries. Reserve primary fund. Run means people are trying to lined up to pull their deposits. So when people are lined up to pull their deposits, the financial intermediaries have difficulties to service them, because they don't keep all the money deposited by people in money form. They invest them, they lend them, they keep only a liquid portion, right? So when everybody is trying to withdraw, pull money, so they have to sell their assets, and this is a fire sale. When you are exposed to a fire sale, what happens there is you don't get the market price. You are forced to sell well below market levels. And also, when everybody is panicking, nobody is buying. They think, okay, markets are going to crash down, so we are not necessarily buying now. We are also in the selling side. So it's not a market. Everybody is in one side means it's not a market. Everybody is selling, nobody is buying. So prices basically falling from the heaven, like it's crashing down, right? So prices are basically erasing out the market valuations, right? And they are the programs by the government to kind of resurrect the market in the form of TARP, that is Trouble Asset Relief Program. So when the US government seen these problems, now expanding into entire financial market, and not only limiting to the financial market, but it's going beyond, and other enterprises also engage in all these difficulties. And US government has started kind of introducing many programs. So this is much more troublesome phase where big assets of big corporations in US were brought in by the government through these trouble asset relief programs. So they had to provide liquidity, they had to buy assets from the market to create a market, because there's nobody is buying. The US government and its affiliated agencies, they were started kind of purchasing. And even the US Fed Reserve, the central bank, was buying assets, sometimes a very low credit rated assets too. They were started buying. Usually they buy government papers. They continue to expand those purchases. So it's a very, very interesting period to kind of analyze how they have faced this troublesome period in US. And then of course, what caused the transformation from what appeared mid 2018 to be a significant but fairly mild financial disruption. That's what they experienced prior to August, and earlier September also they predicted it would not be a big problem, but into a fully fledged global financial crisis. Not only that stopped at America's financial system, it spreaded out from America to rest of the world, and countries like Sri Lanka also felt. We had difficulties during that period. Okay, so did the government responses to the global financial crisis help avoid a worldwide depression? Is still debatable, but to great extent, yes. Now you can go back and say the concerted effort across all the countries during that period has prevented the world is falling back to a situation like Great Depression in late 1920s and early 1930s. Okay, so what challenge do these governments' intervention raise for the world financial system and the economy going forward is still kind of discussed in many forums. And today, some elements of the problems that we faced in 2008 is reappearing through COVID-19 related economic downturn, economic crisis. It is much more troublesome because the financial crisis is not necessarily health driven. Here it's health driven. You cannot necessarily start economic activities. You don't necessarily see the risk of the COVID-19. COVID-19 is much more difficult circumstances now the world is facing. Okay, financial crisis had its lessons now being discussed to great extent in current circumstances too. So let's see how these phases in the financial crisis has helped in terms of economies to recover, and also the experiences from economic sense in this discussion. So that's the kind of a preview and the focus of this section of discussion. Any question before I move on with the further clarification and discussion on this? Right. So what you are simply seeing here is another web address. If you go to this web address, right, you would easily see. I'm not sure whether you can see this handout that I'm just showing to you. So this is the home page that you will see when you go to the web address I have typed there. Right? So that summarizes the 2008 financial crisis, the Great Recession by the numbers. So they give numbers which are mind-boggling in terms of the significance of those numbers. And some numbers, by looking at, you will see it's much bigger than the small economies like us, right? Some numbers they discuss there is sometimes much bigger than you pool all emerging market economies. Okay, so they discuss about what the difficulties in terms of unemployment, the housing prices collapse. Okay, what's the money people pulled out from difficult assets to much more safer government papers like US treasuries, the bailout schemes, the government measures to kind of create a market. Okay, how much different agencies injected in the form of finances to different agencies of the US economy, and subsequently how they close those positions, because you initially purchase some assets, but subsequently when the market started improving, those assets been again sold to the market and you cleared your position. Especially the Federal Reserve and the US Treasury, they invested in assets they usually do not kind of even look at, right? Those assets were not quality assets in the eyes of those agencies, but still they have invested in those because of the crisis. And after a point, they have sold them, cleared their position with some profit. So that means the economies have recovered. How quickly that happened, how duration wise, how long that lasted, all interesting aspects that you can analyze through these discussions. Okay, so go to this site and try to kind of read through basic elements, so that would give you some understanding about the financial crisis that we are going to discuss. And also you probably see these elements in many other literature. So if you just type financial crisis of 2008, you will have enormous amount of literature to have a look. You don't need to go through all that. Just get a glance of some of the very important few explanation that would be ideal for you to kind of get a picture. But at the same time, you can still watch some of the movies, right? There were quite interesting movies with respect to financial crisis that can be easily accessible through the YouTube. So you can go to those movies and watch them. So you will see how the world has gone from prosperity to desperation, and then losing all their net worths and collapsing, and then again coming back, some financial intermediaries. So you can see them. You can kind of get a feel how the markets were during that period of financial crisis. So it's very interesting, and I hope you will find time to kind of get hold of some of these elements to enlighten yourself. That would keep this topic in your head for a longer duration, for longer time, and that would help you to easily understand some element of discussion. Right. So when you see the financial crisis, right? So still people are not fully confident that we have completely come out from the 2008 financial crisis. Even IMF sometimes worry the world economy at risk of another financial crash. Okay, so you can kind of feel it. These elements are now again aggravated with COVID-19 circumstances in today's context. But what you are simply seeing is the global lending agencies, multilateral agencies like IMF, World Bank, is seeing the debt numbers, right, of countries pooled together is well above 2008 level. Okay, and failure in the form of reforming the banking system could trigger further crisis, financial crash, is a kind of warning signal some of these agencies are highlighting. Yes, there were reforms, right? So the financial agencies started kind of bringing in a lot of areas that covered the problems that they have faced in 2018 and 2008 and before, but still now new emerging problems and risks are keeping these agencies to worry that the financial crisis is not over. Okay, so you can see the world economy is at the risk of another financial meltdown following the failure of governments and regulators. Regulators are mostly the central banks and to some extent financial services authorities to push through the required reforms needed to protect the financial system from all these reckless, that is nothing but the adverse selection, and then of course moral hazard. Okay, and everything that we are discussing here is asymmetry driven. So the IMF also signals that asymmetry driven problems are going to be not only challenging us in terms of to making our financial structures efficient, but also it is kind of contributing to collapses of financial markets and magnitude of financial crisis kind problems to repeat. So you can see these things in most of the literature that you might see if you try to kind of read through some of the financial crisis literature. And you define now, what is a financial crisis? It is very important, okay, to understand that the financial crisis occurs when there's a particularly large disruption to information flows in financial markets. So the financial markets are always required to have so-called information efficiency. That's where the markets are defined, the prices are determined. Okay, so to derive the prices, you require information. So if the information are disrupted, information available are only one way, you probably see the markets are collapsing. Everybody is in one side of the market. Everybody is sellers. Everybody is selling. Nobody is buying. So then where's the equilibrium price? How you can define equilibrium price? Right? So these are the problems. So the financial crisis occurs when there's a large disruption to information flows in financial markets. Please remember this large disruption and information flows whenever you write the financial crisis. So if you can't highlight this, you probably make use of whatever the wording kind of a style, no problem with that. So you can write it after getting the message and the understanding, rather than try to kind of memorize and write something. That's not the style I encourage you on. So just take the message into your head, and then you can write in your own style, but main elements of the message has to be there. So the large disruption to information flows is very important when you are defining a financial crisis, right? So with the results that financial frictions increase sharply, frictions are breakdowns increase sharply, okay, and financial markets stop functioning. If everybody is in one side, financial market stops, market get closed. Sometimes the markets are not operational because of these problems, because the informations are not flowing across the market participants, and markets basically kind of get into breakdowns and very frequently, and you find markets be not functioning because everyone is in one side. So that's why the government's required to come in, other agencies required to come in and assist in such circumstances. So you should be able to define this financial crisis in the form of large disruption to information flows in the financial markets. This results in financial frictions and financial markets non-functioning. So these elements has to be there. So please underline them and keep it with you and try to understand that this is where you should understanding financial crisis in a very clear sense, to see that disruption to information flows, right, resulting in financial frictions to increase, and also non-functioning of markets, financial markets. So then you see immediately this contributes in the balance sheet effects, asset market effects on balance sheets. Okay, you see that the values of all the assets you held in your portfolio or in your balance sheets are now crashing down. Okay, so you had equities, that's your portfolio, your company is worth this $1 billion. Immediately seeing you are falling from the roof, you are basically crashing down because your stocks were $350 1 hour ago. Now it seems like it's a penny. So it's like nobody is buying that stock. So there's no price. I mean, when the markets crashes, the crashes that hard where you find your assets are now worthless. Okay, so when your stock market prices decline, your stock values decline, that reduces the net worth of corporations. So you are a $1 trillion company, now you look like $1 million company. So you see the difference in the kind of way in which the crisis shapes in terms of the balance sheet effects. So your net worth has reduced, so you can't borrow, you can't fund big projects which requires many billions with $1 million company. Okay, so your net worth is not worth now. Previously you had collaterals of your stocks which were worth billions, are now not worth at all. So this is what exactly happened when the stock market crashes. Okay, so then you see at the same time, okay, unanticipated decline in the price level. So you expect prices to increase, that means inflation to prevail, not necessarily high inflation, but small positive inflation is always encouraged. So everybody wants a small a low single digit number. Sri Lanka is targeting mid single digit numbers because it's an emerging and developing economy. So they require an element of inflation. So that's make people to expect tomorrow's prices to be higher, so they buy today. So if you expect tomorrow's prices to be lower, you probably do not buy today. You can postpone it tomorrow. So likewise, entire economic activities get delayed, postponed. So the resources would not be used if that expectation set in. So the price level started unanticipatedly decline during the financial crisis. As a result, liabilities that you have in your portfolio look big now. So if you have borrowed 1 billion, that 1 billion look same in the financial portfolio, but with less inflation or negative inflation, you see that billion is now many billions, simply because the other side of asset side all going down because of the price levels are now coming down, and as a result net worth is further reducing. Okay, so it's not only unanticipated price level decline, unanticipated decline in value of your currency is also now troubling you when you see a financial crisis, because you see you have exposed yourself for foreign currency assets. Okay, so when you are experiencing a financial crash, financial crisis, you see your currency is also depreciating. So your books are in your domestic currency, your balance sheet is in your domestic currency. You see, when your currency is weakening, depreciating, all your foreign liabilities look much bigger than what it was. Okay, so your debt is in foreign currency. The $1 billion is now worth, in current exchange rate, it is about 185 billion in Sri Lankan rupee. But if you see the currency is 200, it look 200 billion rupees in your books. Okay, so it's a kind of a similar kind of a circumstance. You see your liabilities look much bigger, and it's profound because of your currency's weakness. So when you see a financial crash, your currencies also get hit, because everybody tries to pull out from your assets market, try to convert your domestic currency assets into foreign currencies and hold them in foreign currencies. So once that happens, your currency also weakens. And then complete uh, to complete this cycle, you see, you write down assets in your books. So you must have kept collaterals. That collaterals are now worthless. So you had equities, stocks being pledged as collateral, mortgage houses being pledged as collaterals, vehicles being pledged as collateral, financial assets like bonds being pledged as collateral. So these are losing value. When they lose value, the collateral value of these financial assets also come down. So as a result, you have to take out such assets from your balance sheets to make your balance sheets look better. If not, what happens is all these collaterals that you are keeping is worthless, but that shows that you are non-performing assets, huge non-performing asset portfolio. So after a point, what you do is you write down those assets and you are taking the loss into your books. So to take that loss into your books, if you have a retained earnings or you bring in new injections of capital, that's fair enough. But if not, it's a big difficulty for the business or the financial intermediary to come out from such circumstances. So what you are simply seeing is financial crisis is a very clear disruption to all the economies, and it will be really felt across the balance sheets in the form of all reductions and decreases in net worths, and makes your liabilities look much bigger. And this happens through asset price declines, including stock market declines, and unanticipated declines in price levels, unanticipated depreciation of your currency, and then asset write down. So these are the elements that you see in many of the agencies who experience the financial crisis, and it's not stopped at the agencies that we were discussing, but this also reflected across countries' economies, and the budgets of many countries have reflected these numbers profoundly after the financial crisis, right? So what causes this financial crisis? Right. So you see, now we are moving into kind of the deep end of the financial crisis to understand what factors cause the financial crisis. Okay. So when you see financial crisis, what basically does is your financial institution, I mean financial intermediaries balance sheet start deteriorating, right? So already you have seen your liabilities look big because of many concerns that we discussed in the previous slide. So when you see your balance sheet's liabilities look big, right? What is the asset in your balance sheet? When it comes to a financial intermediary, loans are an assets, deposits are a liability. Okay, so deposits means the money people bring in and give you, and in the sense save with you. So it's a liability, you have to give it to them when they request those money. Okay, what is your asset is using those deposits or other resources that you raise from the market. You can lend to the stakeholders in the economy, or you can purchase real financial assets. So these were the assets, but unfortunately, when you see your balance sheet is deteriorating, your liabilities are getting bigger, your ability to further lend also decline. Even your lending portfolios now look less in value because of the collateral problems, and some of these lendings has to write down simply because they are not worth anymore. So you see the deterioration, and this deterioration is now push you to a position where you will not be able to further lend. So lending requires your balance sheets to look much more stronger. But unfortunately, when your liabilities are further increasing, further lending also get restricted because of these difficulties. Or what happens is, even if you are trying to lend the limited resources that you have, then you will try to charge a higher interest rate because you also becoming risk averse, right? You don't want to take further chances because already the lendings that you have already had in your portfolio, these are not performing, right? If not, they are having in servicing. So you are trying to now see to reduce the possibilities of adverse selection, and also your risk averseness, you are trying to charge a higher interest rates also, so that further reduces the lending probabilities. So then you see the factor that causes is the balance sheet deterioration, and then of course the banking crisis. So when you see the banking crisis, access for financial intermediation also become challenging. When the banks are in crisis, they are not necessarily allocating resources. Even if they have resources, let's say from government agencies like central banks, they are pumping in liquidity, they are acting in the form of lender of last resort. But still, banks are not necessarily ready to kind of, lend them out because they are in crisis. They are having difficulties because they see loss of information production and disintermediation in the market, simply because whatever the information available with them is in the eyes of the bank is not sufficient. They might think the information available would not necessarily revealing the right true circumstance of the financial intermediation required. So what they are basically seeing is the kind of a problem of asymmetry. Okay, enlarge asymmetry simply because everybody is not buying, everybody is selling. So when everybody is selling, they probably see no price determination process. So at what price I'm going to value this asset? Okay, so the information is not necessarily coming out, market determined prices are not there, nobody is there to quote a price to buy an asset. So even the assets that they have would look idle because they are not in a position to market them. And if you all are working in treasuries of financial intermediaries, you will not know some of the elements that I'm just highlighting. And then, of course, another element is the uncertainty. So uncertainty makes again the lending to reduce. So you don't know when the market would return to normalcy. So this is exactly even during COVID time, everybody is uncertain. They are not sure when the economy will return to normalcy, when the regular economic activities resume. whether the health circumstances improve. Everybody is precautionary. They are not ready to take the regular activities forward because it's uncertain, right? So when you see your uncertainty in the form of your income, in the form of your activities, in the form of your business, enterprises, other related engagements, you see everything now reduces, and the lending possibilities by the financial intermediaries also reduce, because they know if I lend into an organization, whether that organization will function, whether that organization will be able to kind of work and bring back the required return. So they are kind of having this uncertainty running. So you probably see these are causing further crisis in the financial system. So these factors, the balance sheet deterioration, the banking crisis, if it stops at one bank, fine. If it's spread out, it would be much more bigger challenge in the form of entire financial market is losing confidence in financial intermediation. Okay, so ultimately it further increases the uncertainty in the market itself. Any questions? Any questions from what we discussed up to now? Right. So then you see the apart from what we discussed there, you also see the increases in interest rates, simply because the policy authorities might reduce the interest rate, but unfortunately the financial intermediaries or the agencies are not ready to pass on that reduction in interest rates to economic agents. They simply see the uncertainty driven, and also the agencies who are trying to access them are the lemons, okay, and moral hazard driven. So this itself pushes the interest rates, and they also now become risk averse to great extent, and they try to kind of charge higher interest rates. Okay, so when you see interest rates also increasing, even the people who are now ready to come and access the financial intermediation thinks that they are not getting the right price for their project, and therefore it's no use going to the financial intermediaries, and they also roll back their projects because they simply see their proposals cannot be carried forward with a higher interest cost that they had to bear. So who would come to borrow under such circumstances? Again, the riskier borrowers. So that increases further the wrong selection, adverse selection. So ultimately, increasing interest rates contribute to further increase the adverse selection problem. Okay, and also increases need for external funds, and therefore adverse selection and moral hazard. This implies that, okay, when you see the interest rates are increasing, you tend to see the riskiness of the engagement. So what happens there is you don't bring in your own capital, right? So you try to make use of third party funding like financial intermediaries to fund, and through which, right, that again contributes to further the adverse selection problem and moral hazards. So you will try to, once you start the activities, you would take more risks than what you used to and what is defined by the contracts and obligations. Okay, so the increase in interest rate is also another factor that causes the financial crisis. And you go back to the US subprime problem, you probably see this. We will discuss that, where the markets been subject to the rate revisions in the 2005-2006 period. So the US had worries that the market is overheating now. Overheating means economy is growing beyond its potential. So some slowdown is required because they felt the inflation also would pop up with the overheating that they were experiencing. So what they were introducing was to tighten the monetary policies and other relevant policies. So that contributed to increase the interest rate. As interest rate increases, the people who had financed through mortgages are not in a position to service from one side. So they started defaulting. So as a result, the crisis of prices in the mortgage market started collapsing little by little, and it spread out to a wider kind of a problem subsequently. So you see the interest rate increases not only increase the adverse selection, but also that pushes the enterprises and organizations to rely on external funds. It is not sourced within the organization in the form of retained earnings or the injection of capital owners funds, but they are trying to kind of rely on third party funds, and they are by sourcing third party funds, they are also looking at possibilities that there's more moral hazard options. So then, of course, another cause for financial crisis is the government's fiscal problems, because governments might run budget deficits, continuous high budget deficits, create problems, and through which you probably see many imbalances in the economy, and that creates possibilities that the government would default. Government would not be able to service its obligations. Okay, they have liabilities in the form of the debt that they have raised already that would not be able to pay out. So not only the debt in domestic currency but foreign currencies also. So would I mean, that would kind of compel these agencies to look at options to see how best they can meet their obligations. So the fiscal problems again destabilizes the market and create fears among investors that the governments would not be able to honor its obligation, and investors who are ready to come and invest in those economies try to pull their investments, and as a result further problems in the form of asset price collapses in the equity market, in the debt market, and also demand for real estates and other related assets also declines. And then the foreign investment requirement in those countries, because most of the emerging and developing economies have saving investment gap. So your investment requirement is much greater than your saving probability. So the balance portion or the gap of a saving and investment requires to be channeled from external funds, the foreign funds. So the foreign investors has to come and invest in those economies. But unfortunately, when a circumstance like this happens, they also pull out. So such circumstances leads to further imbalances that creates a lot of uncertainty in the form of foreign investments in those economies. So this also a factor which causes financial crisis, and you can see now it is not only the financial institutions balance sheet, banking crisis, and also the uncertainty, but also the higher interest rates and higher fiscal deficits. This creates kind of possibilities for financial crisis in the economy. Okay, so now we will move into different phases in the financial crisis in the advanced economies first, before we move into emerging and developing economies, because this is kind of try to explain the experience of some of these advanced economies, and through which how different stages that they have experienced and the circumstances that driven into the economic decision making. Any questions? Right. There were a few questions also. You all have sent it here. So what I simply see here is adverse selection is also can be addressed, okay, by regulation, where you introduce regulation to bring in more information. Why you select the wrong borrower? Simply because you don't have required information. Okay, so the required information would bring in the form of regulations would facilitate, right, people to select, financial intermediaries to select the right parties for transactions. Okay, so this again uh, uh, kind of bring in certain elements, like you see now in any economies, you can find so-called credit information bureaus, crib, right? So the crib would not only record your previous history of lending experiences with financial intermediaries. Similarly, in other countries, they bring in other elements of orderly behavior of these economic agents. If you have a history of defaulting your phone bills, if you have a history of defaulting your utility bills, you have history of how you have conducted yourself in the form of student loans or education related loans that you have accessed. So there are various elements through which, you know, the availability of information through wide access arrangements facilitate through regulation would help to increase the 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 so-called symmetry, because that information is available, but reduce the asymmetry, and through which the adverse selection. So you are not necessarily selecting the wrong parties for transactions, then you are selecting the right parties for transaction. This is not only the one side of the equation, you have to see the other side also, where the organization itself, when they try to source funds directly through direct finance arrangements, the investors requires to know what these organizations intentions are, what's their real circumstances. So the listing requirements from one side requires these agencies to reveal on a regular basis some information: audited accounts, their project proposals, new investments, and new economic activities, even the people who manage these assets, right? The principals and agents of the organization. This is required. So what the regulation helps is it in fact increases the information availability, and through which it reduces the asymmetry. So when you reduce the asymmetry, you enhance the right probability that you select the right stakeholders for transactions. So that means you are reducing the adverse selection. Okay, so that's, I believe, solve one of the concerns you all have highlighted. And the next element is sudden asset price increases, especially the real assets in the form of gold, whether it's related to COVID-19 related recession. What we have simply seen is when the global economy facing recessions, the demand for real assets increases. Okay, so other thing is when the economies, especially the emerging and developing economies and also advanced economies, they have economic downturns, you probably see the demand for safe haven assets, so-called safe haven assets. So safest financial assets in the world are often being demanded. So often the US treasuries, that's remain everybody's reserve assets. Everybody buys US assets, US treasury assets. Okay, US treasury bills or treasury bonds. Even government of Sri Lanka holds US treasury bonds and treasury bills. Okay, that's one of the elements. And then of course German bunds, they call it bunds, not bonds. So the German bunds is one of the another assets that you see. Similarly, Japanese JGBs, Japanese government bonds. So when you see the financial stress or economic downturn, the interest rates of US treasuries, German bonds, Japanese JGBs, and even UK government papers tend to reduce. So that means more demand is there for those assets. And then the kind of element is when the US dollar does not necessarily strengthen. So US dollar strengthen weakens, people start demanding gold. Gold prices increases. And similarly, the people who wanted to buy the financial assets are now reducing some elements in the form of buying them, and they move into the kind of assets like gold. So they move into gold assets, and gold prices also increases, right? So recent increase in gold prices also you can kind of link up to some extent with shifting of asset preferences, and also the risk averse behavior of investors. Investors want to take out risky elements of investments because gold is a real asset. You have the gold, and gold prices at times of recessions increases because more people demand such assets. And similarly, you can see so-called safe haven assets. Okay, so I believe this clarifies the concerns some of you all have highlighted. And similarly, if you have any further questions, you can also put it to the chat. So while discussing, I'll go back and I'll see what clarification you required in terms of those questions. I hope that cleared your concern. So we looked at factors that caused the financial crisis, and now we look at different stages of financial crisis across advanced economies. Okay, so the stage one in advanced economies is so-called initiation of financial crisis. So here, this phase to some extent been explained by so-called mismanagement of financial liberalization. In these markets, the openness of the financial markets and the continuous financial innovations. Okay, in advanced economies, you probably see the financial products that comes very often. New financial assets, new financial products, new financial arrangements. Okay, so these being mismanaged to great extent is also one cause of initial phases of financial crisis in these economies. We will get into those. I will give you very clear examples and we can discuss those stuff. And then you see asset price boom and bust. Asset prices are continuously increasing. So it's a boom cycle. Then all of a sudden it's bust, it collapses, especially the real estate market. Okay, housing bubbles bust, bubbles burst, right? So the asset prices is similarly, it collapse. So so-called a music video, you can watch that in Google. This is Keynes versus Hayek. Okay, Keynes is John Maynard Keynes, famous UK and Anglo-Saxon economics versus Austrian economist Hayek, right? You go and type Keynes versus Hayek in Google, you will see a very nice music video that shows the boom and bust cycles, where the asset prices are in one direction, increasing on a continuous basis. So blindly people put their money expecting tomorrow, next month, next year's prices to be higher. So they expect return. Your all investments are there. So when those assets prices collapse all of a sudden, right? So you are worthless. Your net worth crashes. Okay, so your collateral becomes worthless. So this is one element where people are looked at in terms of asset price booms and bust cycles in advanced economies. That is also one initial phase of this problem. Then, as I just touched upon, some spikes in interest rates. Interest rate were maintained too low for too long. Right? When you maintain interest rates too low for too long, the real price of risk is not determined in the market. So the risk also hidden because of lower interest cost. So when the interest rates are low, interest is also, the risk of investments also not visible. So you find when the interest rate started going up all of a sudden, risks started showing up and started collapsing. So spikes in interest rates also blamed to some extent as an initiation of financial crisis. Then uncertainty. All of a sudden, everybody is not confident of economy's continuous growth, economy's robustness. They are worried what would happen with the COVID, and everybody is not happy to buy. So everything get postponed. So it's uncertain. So these elements, right? These elements contributed in the initial stage of financial crisis in advanced economies. Then you see two different stages. One is banking crisis and the other one is debt deflation. I'll get back to those with retail. So I prefer to listen to hear to you all if you have any further questions on these areas that we discussed today before we move into the continue our discussion in terms of greater details of this stage 1 and moving into stage 2 and stage 3 of this financial crisis in the next class. So if you have any questions, please feel free to type it and pass it on so I can follow up. We will stop at this point today, and we will start continuing our discussion further into the next week, and then of course we will see other topics in the coming weeks. Any questions? Okay, if you don't have any further question, we will stop at this point today, and we will start from our discussion into the stage 1 with greater details and move into stage 2 and 3 in financial crisis in our next class. Thank you.